welcome to our channel. So today we'll talk about different option strategies and how KEEV is going to help you execute them on our platform. So firstly, the option strategies are divided in the following ways. The normal bullish, that is basically how you can execute a bullish view through an option strategy. And that can be executed via a naked option strategy, that is just a simple call buy, or it can be executed through a hedge strategy, that is a bull call spread. And the same way, there is a difference between bullish and a neutral bullish that will be seen with the payoff charts through KEEV. And here we can execute that through put sell or a bull put spread. That is the hedged version of put sell. So moving forward, as we can see in our platform, option strategy. This is one of our newer features, and I'll give a brief overview on how you can use it. So here, going to the page, you will see two options: create a strategy and advanced option strategy builder. So here you can execute and you can backtest your strategy, you can live trade. But for the purposes of this video, we'll be mainly using this part where we'll be creating a strategy. So here, for example, let's use the example of Concor. As we saw from the chart in the past week that Concor has been giving a good uh, chart pattern or a bullish breakout. As you can see on the chart here, it gave a breakout from this region around 650 and it is going around 660. And based on the pattern here, we can see it is either a rounded bottom or a cup and handle breakout pattern. And here we can see that by looking at this chart, we can see that yes, it's a bullish chart and it has upward momentum going forward. So how can we leverage that with an option strategy, and how is it beneficial? So in the option strategy, so in the bullish, we saw earlier that we are going to, if we are bullish, then we can just do a call buy or a bull call spread or a put sell and a bull put spread. So let's compare these strategies on Concor and how their payoffs are different. So we'll just search for Concor here, and we'll add position. So from add position, there will be the system will directly give you the ATM option. So here we can see that you have the future or options. So we'll select option, then buy or sell. Currently, we want to see a call buy. So your buy, the lot size would be here, and the price of the option would be here. So from here we can see the payoff that will be shown. Naked call buy. Here the position is not hedged as it is just a single leg. It is a call buy. Here, if we want to hedge the position to define the loss properly, then we can sell a OTM call of a further strike price. So here we'll sell it for probably 680, 690, and here we'll see the payoff. So here we can see that the risk reward is properly defined. Earlier we were losing about 950, and here because the position is now hedged, we'll lose less. Here the risk reward ratio is very good. But as we know that the expiry is tomorrow, so ideally the risk reward ratio would vary and the max profit and everything is more defined. So this can only happen from the hedged option as we saw here, the bull call spread. That is what we have seen here. Another way to add the strategy from the key platform would be through this. Here we can just click on insert strategy and scroll till we find bull call spread. And here it will show the strike prices that are system generated. We can change it as in what we like it to. So the other way, after looking at call spread and the bull call spread, we look at the neutral to bearish, that is a put sell and a bull put spread. So here again we can use this to just uh, scroll to get a put sell, naked put short, as we can see here. So here we can see the normal put neutral bullish position of the put sell. You as the current as the system generated 670 strike price, the current price is around 11.05. So when we see the payoff for this, we see that the max profit from this trade will be around 11,000 if the stock price on the day of expiry is above 670, as we can see from the chart here. The break even is around 659. As we can see from here, below 659, the losses will be undefined, and the margin required for this position is also very high. So in order to define the max loss and in order to reduce the margin, we will add a position here that will be around 640 of put, and we'll buy it. So it is currently trading at around 0.25. And if we see the payoff after this, we'll see this chart. So here from the payoff, we can see that earlier the max loss was undefined and the break even was around 654. So here the break even will increase, but at the same time, we'll benefit from reduction in the margin required, which will reduce to around one third of what was required earlier. Max loss is also defined, but earlier we were earning around 11,500 profit. Here, because the position is hedged, our max profit will reduce, but it is beneficial overall. This profit will be profitable as long as the stock price of Concor is above 659 at expiry. So this was the strategy of the bullish view. That is the call buy, bull call spread, put sell, and the bull put spread. So just to conclude, I'll basically give a brief about these names. So here, from a bullish point of view, we can see that the bull call spread, all the three words in the hedged option strategy has meaning. Bull will be your point of view, your view of this particular stock or this particular position is bullish. Call because you'll be using the call side of the options only, and spread because you'll be using two legs. So the bull call spread will be your view, the instrument type used, that is the call, and the spread is basically two legs which you are defining your max loss, max profit, and risk management from that point of view. So here we can see the same in the bull put spread, where the view is bullish, but we'll be using put and spread because there will be two legs to the strategy.